Hello, hello. Welcome back, friends, to Alpha Beta Soup. I'm TXMC. Well, we've got a couple of things I'd like to talk about today, and hopefully I can manage to keep this video on the shorter side. We'll have to find out. But after what's gone on over the weekend, I thought it would be valuable for us to discuss where the market currently sits, where I think that we're headed, and what my current general bias is about direction. So we'll look at the Bitcoin price chart, we'll take a look at some fractals, we'll also show you some on-chain activity, including realized profit and losses, and we'll try to get a sense of what this market looks like. If you enjoy my content, make sure to give my video a thumbs up and subscribe to the channel. I appreciate all of your support, and every one of those little thumbs up and subscriptions helps to improve YouTube's recommendations for this channel and gets our reach out to more people. So thank you. Now let's get into the charts. Today, what I want to talk about is what we think this market looks like. Do we think that this is a bear market? And I think I can lay a case out that we've been in one for a while now, despite the fact that we created an all-time high not that long ago. And, you know, there are a lot of wonderful things to be excited about with Bitcoin. There's a lot of adoption going on. There are new institutions adding it to their balance sheets, making it available to customers. There's a Bitcoin bond in El Salvador. There are nations thinking about making it legal tender or at least decriminalizing their previous harsh stances on it. Lots of great things are happening, but we have to separate those events from the way markets themselves play out in the pricing of assets and the oscillation between supply and demand across market cycles. Those things happen in a sense separately from adoption and exciting news. Sometimes those events then have an effect on price, but many times price kind of does what it wants. And as we sit and look at this current price action, this is very much a bear market fractal. If we hop over and look at this fractal that we took from the 2018 bear market right here, we've been following it since the beginning of October. This is very much bear market price action. And we've been following this really closely. Now, it's pretty weird. It's very uncommon for a price fractal to be followed this long and this closely, but here we are. And we've even gotten little pullbacks of similar length and drawdowns happening right on time. So for now, I think it's fair that we could loosely expect price to generally follow this in lieu of some outsized factor pushing it in a different direction. And I think that a lot of the FUD in the news cycle right now has largely been priced in by the market. Expectations of rate hikes by the Federal Reserve, the fears that they may start reducing their balance sheet by quantitative tightening, concerns that Russia is going to invade Ukraine, which it seems that they are now, at least parts of Ukraine, concerns about energy costs and the spiking price of oil, which is not helped by the events going on in Russia and Ukraine. All these things are essentially factored into the market at this point. They are known factors. And until new information comes out that changes those calculations, I think it's fair to expect that the market, for what it's worth, may have priced in a lot of that FUD. And if that's true, getting a little retrace rally, like what this fractal is hinting at, isn't out of the question. That fractal is also made a little more possible. We didn't break below this level from February 3rd and 4th, which is only on a 4-hour chart. But if we're going to get granular with it here, this is a higher low, and it hasn't yet broken below this line. So maybe we actually get a little bit of a pump here. Price doesn't move in one direction. So it's reasonable to think that after a few days of down, we might get a couple of days of up. That's what we've been doing this whole way, right? We get these drawdowns, then we go sideways, then we get a pump, then we get a drawdown, then we go sideways, maybe we go down again, then we get another pump. Back and forth, back and forth. So for right now, yes, we have been able to hold this level. Maybe it leads to a retrace rally. But if we look at our fractal back here, the retrace rally might not have the kind of steam people are hoping for. And this is actually a textbook retrace rally. If we throw a Fibonacci extension on here, this retrace rally perfectly stalled out between the 618 and the 702 Fibonacci retracement levels, which are the places that we've talked about before being key reversal points for rallies. So if price action is destined to continue following this fractal in the short term, it is suggesting what we've talked about before on this channel, which is the possibility that a retrace rally would stall out in the middle 50s. I still believe that that is the most likely scenario for any rally out of these current price levels, because I believe we are looking at a multi-month bear market. We've already been in one for several months, and it's likely it is going to continue at least in the near future because of everything going on macro and geopolitically. Those things cannot be ignored. And while it's tempting to believe that Bitcoin will break away and decouple from global assets and do its own adoptive surge, I find that to be a less likely scenario and one that I can't plan for. So in the short term, this is what I can plan for. We get a pump and eventually the retrace rally runs out of steam. Or we continue chopping around down in here as my general base case, perhaps set a new low until we get to mid and late March, and the market finds out if the Fed will stay true to its word. And one of the reasons that I say we're in a sort of bear market is because of the lack of activity on chain. Because if you look back a year ago at January 2021, the amount of active addresses on chain, the number of transactions, the amount of transfer volume, all of those things were reaching highs as we broke over 40K for the first time. This was a true bull market rally. It had high volume. There was a lot of supply turnover. We had long-term holders distributing coins. We had miners distributing, whales distributing. It was also the height of the grayscale arbitrage. There were a ton of factors driving price up in the early part of 2021. And as you can see from my charts here, all of those values began slowing down at this point in time. Active addresses went sideways, transaction counts started to taper off, and median transfer volume started to bow over a bit. It did see another spike in May during the sell-off, but the trend started to reverse and slow down. And in the second half of last year, as we rallied up, eventually breaking the previous all-time high, if you notice, volumes on chain never got anywhere near where they were 6 months prior to that. Same thing for transaction counts and active addresses. And during this entire rally up here on this channel, we talked about how remarkable it was that price continued to pump upwards despite a lack of volume, a lack of transactions, and a lack of spending on chain. It's almost like we created an all-time high while still being in a bear market, driven in part from HODLing behavior being very aggressive and also derivatives helping to push the price around, because the derivatives market has expanded significantly in the last year to 18 months. And we have to factor that in to the way price is behaving in the short term. We can also see the diminished volume just by looking at a price chart of Coinbase, which is by far the largest North American spot exchange for Bitcoin. And if you look back here at the beginning of 2021, volumes were spiking heavily, and the moving average itself rising month on month as we ran into this rally all the way up to 50K. And since then, volume has mostly declined structurally, week on week, month on month, and flatlined over the last few months. I mean, just look how unimpressive this volume profile is during this entire all-time high run from late July up through early November. Look at the volume. It's just not there. So we're seeing limited spot volume in addition to these lowered values on chain for address counts and transactions and volumes. So in a sense, it's almost like the bear market began in May of 2021. Although volumes and interest in the asset were already tapering by the time we reached February, the market itself was able to sustain at least some price action until we got to May and it finally rolled over. And since this period in May of last year, so much of the data we look at is demonstrating a general bear market, despite the price action having reached an all-time high in the middle of it. Here's a look at realized profit and loss. At the bottom, we've got realized profits and realized losses on a 14-day basis. And at the top, I've got a ribbon that prints when realized losses are exceeding realized profits. So you can think of those as capitulation events. If you look at the price action coming up into last year, look at the amount of profit realization on a 14-day basis. $1, $2, $3 billion worth of realized profits on chain into the rally. Then we have a pullback, realized profits decline, then another surge over 50K up to 57,000, and a big push of of realized profits. Then as price begins to decline, realized losses are engaged. And you can see here in mid-May when realized losses finally surpassed profits, and we entered a multi-month period of loss realization. This is an extended period of capitulation on chain, until finally price reverses and we see another few weeks of positive price action. The profit realization during the second half of last year was ramping up as we reach up towards the all-time high. Coins bought down in the summer lows were spent again into profit several months later. But if you look at the total sums of realized profit, despite the fact that prices made new highs, the sum of profit realization was about half of what it was earlier in that year, only reaching up to about $1.5 billion generally, after reaching highs of almost $3 billion earlier that year. And if you look at realized losses, they are essentially kind of range bound. We have some elevated realized losses on the tail end of the rally. These are newer hands capitulating into weakness. But even these losses are not as high as the sum total of realized losses from mid and late May. So we had a second rally with higher prices and lower profit and loss realization, in addition to the lower volumes we were just speaking about. This look at realized profit and loss, in a sense, is showing us that the second half of last year never gained the kind of steam and fervor and froth necessary for Bitcoin to experience a true bull run, because the market was not a bull market. When people say bull market, they usually mean prices going up, and that is the outcome of bullish sentiment. But the market itself, underneath the hood, below the outcome of price, was demonstrating weakness. There was a lack of demand. There was a lack of support propping up the price action, so that when we finally started to see weakness in early November, there was not enough underlying demand for Bitcoin to help sustain price, and we collapsed and entered a multi-month drawdown, during which time we've seen almost no proper relief rallies, just a steady, slow, sideways bleed. This here is my liveliness ribbon, and this is one other metric that I'm going to use to demonstrate the bearish behavior, the accumulation style behavior that we're seeing in the market right now. So liveliness is the overall lifetime ratio of on-chain spending versus on-chain accumulation, and it uses Coinbase totals to measure that ratio. So as we've talked about on the channel before, as a coin sits dormant on-chain, each day it acquires one coin day. When that coin is then spent at a point in time, every day that it accrued from the last time it moved is destroyed. And we count coin destruction as a way of measuring the age and volume of spending on chain. The older a coin is, and the more of those old coins there are, the higher amounts of coin destruction when they are spent. So when there's a lot of spending on chain and a lot of coin destruction, liveliness as a metric goes up. When there is accumulation on chain, when spending subsides and the majority of activity are coins sitting dormant and aging, liveliness begins to decline and it starts to slowly trickle back down. So we get big runs up during bull markets and then sideways bleed down in bearish accumulation periods. So now that I've explained how liveliness works, look here at my liveliness ribbon. What this is comparing is the 30-day moving average of liveliness to the yearly moving average. So it's comparing short-term behavior on chain to the last year of behavior. What we can see going back to 2014 is that this ribbon does a pretty good job of showing you periods where the market is showing high volumes of spending, which is usually in bullish periods. Here in the 2016-17 bull run, it was all blue, printing straight up. And then on the back side of the move, as spending begins to decline, you see the peak of liveliness begin to pull back until finally it breaks down and prints an orange ribbon, showing you that accumulation has finally taken back over from the year-long average of liveliness. Sometimes this value only prints for a few months. We started to see spikes in spending in this trough here in 2018 that made this print of the liveliness ribbon relatively short-lived. And what we can see over here, if we look at the late 2020 rally, as price was curling around the previous all-time high at 19.5K, that was where spending really started to pick up. And that's actually the moment where the liveliness ribbon stopped printing its bearish orange print and showed that the spending behavior of the bull market had resumed. But look over here at the recent price action. Here we are zooming in on the last couple of years of my Liveliness Ribbon. And if you look over here, it actually started printing in late November, before we reached this December 4th wipeout in liquidations in the futures market. The Liveliness Ribbon actually started printing just a couple of weeks after the all-time high. I remember tweeting this out and saying, wow, this is really amazing. The amount of coin spending on chain is a fraction of what it normally is during a bull run. This is remarkable. But what I didn't understand about that moment and have since come to realize was that that was actually the warning sign that the market was not able to sustain the rally. What we've seen in the weeks and months following is that the Liveliness Ribbon has continued to print and in fact is expanding. So the on-chain data was showing us that the rally in October was not strong enough to sustain itself. But analysts like myself made the mistake of thinking that we were entering some new paradigm where the rally was going to continue bursting into new highs despite the fact that there was very little churn of supply, very little volume. That's a learning for myself, and it's part of the reason why in the time since I have pivoted to being more bearish, because the market is showing a clear preference for downside. Here's a look at our HODL waves. And while I've expressed a lot of bearishness and we're talking about how the market feels like a bear market, there are positives to take away. And one of those positives is the amount of HODLing going on chain. So when we look at HODL waves, we're looking at the distribution of Bitcoin supply based on the time at which it last moved. Right now, I've filtered it down to where we're only looking at the Bitcoin supply that has been sitting dormant for at least 6 months. The total percentage of supply that this now represents is about 77%, and it recently broke over the previous all-time high set in October of 2015. Now there's a positive and a slight negative observation that I can point out about this metric. So the negative, if I were to call it that, or the con to us being at an all-time high for 6-month and older HODL wave, is that this usually happens in the depths of a bear market. This all-time high previously was in the very center of the terrifying Mt. Gox bear market that lasted from 2014 to 2017. It was right in the middle of it, in the lows. And that's where we saw the highest amount of accumulation by older coins. And the interesting thing is we've now climbed all the way back up to all-time highs of 6-month and older coins, despite the fact that we had an all-time high just about 4 months ago. And that's because the hodling behavior really began when the bear market began in May of last year. That's when all of these values started climbing back up to the positive after heavy distribution into the January-February peak. Hodlers and people looking to realize 5x, 8x, 10x profits from the previous bear market, they had their distribution period at the beginning of 2021. And the market, for its part, hadn't fully reset by the time derivatives and hodling helped push price all the way back up to the all-time high again in October of last year. So we've got a lot of hodling going on, but based on historical trend and the times in the market when this usually happens, it would suggest that we have been in a bear market for at least 8 or 9 months now. But on a positive note, what this does mean is that Bitcoin is now ideally positioned for when demand does return, right? Because the amount of supply that is being restricted by investors who have longer time preferences, lower time preferences, people who aren't necessarily looking to make a 2-week swing trade and profit out. Those kind of hodlers have accumulated just as much supply as they've ever had, more than they've ever had before, percentage-wise. And so the kindling is laid out on the floor for Bitcoin to be extremely responsive to a little struck match of demand to be thrown on top of it. But I think that we may be a period of time away from the market being ready to give us that kind of demand. Now, obviously, if some major positive news event comes out that drives a unique adoption surge, we may see some of these patterns deviate. But from a cyclical market perspective, Bitcoin is currently following equities, and equities themselves are on a sideways and down track as we wait for Federal Reserve clarity, and we wait to see if Russia's really going to invade Ukraine Ukraine, and if the West is actually going to respond to those actions, as they have been threatening to do. All of that uncertainty needs to be ironed out a little bit before the market is ready to move in a clear direction of positivity. But what we can say is that Bitcoin looks to have already gone through its capitulative phase, at least the majority parts of it. We had one of those big phases from May to July, and then again we saw more realized losses just in the last couple of months. Now, if some horrible events unfold and all of the markets tank, Bitcoin will go down with it. But from a historical trend perspective, all of the kind of hodling that we want to see, the kind of supply moving from weak to strong hands, and the sort of capitulative behavior that you would expect on the backside of an all-time high break, all of those things have played out exactly as we would expect them to. The only differences here is the lack of volume and the lack of demand at the recent all-time high, because in a lot of ways, we're still in a bear market that began 9 months ago. So when we look at the price action here, after we've discussed the amount of hodling going on, the lack of volume, the lack of demand, maybe we set a little local low here. Maybe we get a rally. But my current base expectation is that any upside from this current spot in the existing market climate is bound to likely run out of steam somewhere in this region, between 55 and 58,000. And we'd still have to get a lot of work done to even get to that level, including breaking over 50K. And there's actually a lot of supply sitting in this region right here. So be careful of sentiment, particularly on Twitter. If we do start to see a minor pump, especially if we're able to get back up to the tops of the wicks from this recent local high, here around 45, 46,000, sentiment is going to flip positive on Twitter, especially very quickly, because people are looking to cling to anything bullish that justifies their own bias, because everyone wants the number to go up quickly. But if we're looking at the market objectively, if we're taking in all of our data points, there's more bearishness than bullishness right now. And structurally, I still think that there's a likelihood that we eventually touch these prices again. And I will not feel that that is unlikely until a bunch of things start to change in this market. So just make sure you're keeping your head on straight in these times. Don't let the news media drive your emotions too high, because that's where they make their money. That's the crux of what I wanted to talk about today. I really just wanted to lay out what I've been thinking about over the weekend. There aren't a ton of new, exciting insights to pull out of the data, but this is a time where it's very important to stay grounded in our fundamentals and remind ourselves of the reality. There is intense hodling going on. There is a lack of physical demand for spot Bitcoin. Markets globally have been de-risking for about 4 months, and there's still a bit of bearishness ahead of us on the calendar between what's going on in Russia and Ukraine, what's happening in the Federal Reserve over the next couple of weeks. It's just not a time to take an aggressive call on where you think the market's going, not from my perspective. So I continue to patiently observe and remind myself of the facts. Make sure you're following me here on Twitter at TXMC Trades. You should know by now that I post tons of charts and analysis on there. I like to go on Twitter Spaces, and it's a great place for us to talk and get to know each other a little bit. We may do a live stream here later in this week. If it's something you're interested in, make sure you tell me about it in the comments. And also leave any feedback or questions you have for me there as well. I hope that you're doing all right. I hope you had an enjoyable weekend. Try to unplug from the news a little bit. We'll talk again in a couple of days when we have a little more to discuss. Take care of yourselves, friends. Be kind to one another, and we'll speak very soon. Cheers.